Hello friends, I am Alka Sharma. Today we are going to study about BMS semester 5th subject investment analysis and portfolio management. It's very interesting come theory practical subject. In this subject there are 4 modules. Module 1, Introduction to Investment Environment. Module 2, Risk Return Relationship. So it is basically all about risk return. Module 3, it's related with portfolio management and security analysis. Module 4, that is theory, capital asset pricing module and portfolio measurement performance. So these are the 4 modules in this subject. Let's study module 1, Introduction to Investment Environment. So, what is the investment? Investment is basically the employment of funds with the aim of getting return on it. In general terms, investment means the use of money in the hope of making more money. For example, the money you earn is partially spent and rest saved for making the future expenses. Instead of keeping the money idle, you may like to use saving in order to get return on it in the future, and this is called an investment. Money can be invested in fixed income products like bank deposit like FG, RD, and market product like shares and mutual funds, and non-financial assets like physical gold and real estate. There are two types concepts of investment. First one is economic investment and second one is the financial investment. The concept of economic investment means addition to the capital stock of the society. The capital stock of the society is the goods which are used in production of other goods. The term investment implies the formation of new and productive capital in the form of new construction and produce durable instruments such as plant and machinery, inventories, and human capital are also included in this concept. Thus, an investment in economic terms means an increase in building, equipment, coal, etc. Now, second concept, that is financial investment. This is an allocation of monetary resources to assets that are expected to yield some gain and return over a given period of time. It is general or extended sense of the term. It means as exchange of financial claims such as shares and bonds, real estate, etc. Financial investment involves contracts written and piece of paper such as shares and debentures. People invest their funds in shares, debentures and fixed deposit, national savings certificate, that is called NSC, life insurance policies, provident funds, etc. In their view, investment is a commitment of funds to derive future income in the form of interest, dividends, pensions, benefits, and the appreciation of the value of their principal capital. Now, let's discuss module 1, next topic, that is investment process. There are 5 investment processes that help you in selecting and investing in the best asset class according to your needs and preferences. Now, step 1. The first steps about the understanding the client. The first and foremost step of investment process is to understand the client or investor, her needs, his risk-taking capacity and his tax status. After getting an insight of the goals and restraints of the clients, it is important to set a benchmark for the client's portfolio management, in which it will help in evaluating the performance and check whether the client's objectives are achieved. So this is all about step 1. Now step 2. Step 2 is about asset allocation decision. This step involves decision on how to allocate the investment across different asset classes, that is fixed income securities, equity, real estate, etc. It also involves decision of whether to invest in domestic assets or in foreign assets. The investor will make this decision after considering the macroeconomic conditions like monetary policies, national economic policy, fiscal policy and overall market status. Now step 3. Step 3 is portfolio strategy selection. It is a third step in which the investment process is to select proper strategy of portfolio creation. Choosing the right strategy for portfolio creation is very important, as it forms the basis of selecting the assets that will be added in the portfolio management process. The strategy that conforms to the investment policies and investment objectives should be selected. There are two types of portfolio strategy. The first one is active management and second one is passive management. Now, first, active portfolio management process refers to a strategy where the objectives of investing is to outperform the market return compared to a specific benchmark by either buying securities that are undervalued or by short selling securities that are overvalued. In this strategy, risk and return both are high. This strategy is proactive strategy. It requires close attention by the investor or the fund manager. Now, second one is passive portfolio management process refers to the strategy where the purpose is to generate returns equal to that of the market. It is a reactive strategy, as the fund manager or the investors react after the market has responded. Now step 4, asset selection decision. In asset selection decision, the investor needs to select the assets to be placed in the portfolio management process. In the fourth step, within each asset class, there are different sub-asset classes. For example, in equity, which stocks should be chosen? Within the fixed income security class, which bonds should be chosen? Also, the investment objectives should be conformed to the investment policies, because otherwise the main purpose of investment management process would become meaningless. So this is all about the fourth step. Now the fifth step, that is evaluating portfolio performance. This is the final step in the investment process, which evaluates the portfolio management process and performance. This is a very important step, as it measures with respect to a benchmark in both absolute and relative terms. The investors would determine whether his objectives are being achieved or not. So, conclusion, we can say that after all the above points have been followed, the investor needs to keep monitoring the portfolio management, performance, at an appropriate interval. If the investor finds that any asset is not performing well, he/she should rebalance the portfolio. Rebalancing means here adding or removing, or better call it by adjusting some assets from portfolio to maintain the target level. Rebalancing helps the investor to maintain his/her level of risk and return. So this is all about investment process. Now let's discuss next topic of module 1. What is the difference between investment, speculation and gambling? So first, concept of investment. Investment can mean many things, but particularly in the financial market, it means putting your money into something. According to the financial experts Frank K. Relly and Kate C. Brown, investment is the current commitment of resources for some time to derive future payments that will compensate the investor for time invested, expected rate of inflation, and uncertainty of future payments. For example, investor genuinely investing for the long term in a high revenue generating company after proper analysis. Okay, now he buys shares worth rupees 10,000 and expecting at least rupees 50 dividends on them. So this is all about the investment. Okay, now second, speculation. So what is speculation? When we talk about speculation in terms of financial market, it refers to making investment without proper or incomplete knowledge and information. So speculation always invests in short-term plans to leverage the price fluctuations that occur in short period. Without having enough knowledge, the speculation tend to expose themselves to higher risks. So for example, in a speculation, a speculator who buys 50 shares of a company, let us assume for rupees 3,000. Okay, now the price of the same shares becomes rupees 4,000 due to price fluctuation. So the person sells the shares and earns profit of rupees 1,000. So this is about the speculation. Now next one is gambling. So what is the gambling? Gambling is very much different from the above two concepts, investment and speculation. It is totally different. As gambling purely depends on intuition or instincts of the investor. The investor trusts his instincts and sole basis that he employ his money in hope of winning that gamble to earn profits. However, the chance of winning that gamble is particularly very less. This gameplay is less of economic activity and more of an artificial activity, which is played with instincts. For example, a person putting all his money in a horse race or casino is referred to as gambling. So this is a gamble as the investor is not backed by any information or analysis and the chances of winning are unknown. So this is all about